Well, thank you, Rick. I thought that was just fantastic. And we're ready to move on to questions and answers. I just wanted to say one thing before we begin. I know that Rick went over a lot of content, and there's already a lot of questions in the chat box. It would be helpful for me if you had a particular question about, say, a slide, 30 minutes ago, or something specific about the Robinsons. Please, rephrase the question and give me a little context, so we don't have to kind of guess what exactly you might have been referencing 30 or 40 minutes ago. But with that, we'll begin. And I just want to start with this question from Sherry. And she says, what are your thoughts on fractional ownership for a vacation property?
Well, fractional ownership allows you to, we've got to be a little careful here. If we're talking about timeshares, it's an area I don't know a great deal about. My sense is that in some cases, timeshares can be difficult to sell. And so if one was going to make that kind of investment, one would want to be sure that there's a sort of a thriving secondary market so that one could exit. It's really easy to get in, but it's not so easy to get out. And in general, I think that's what I would think about, that it's very attractive because it allows you to pay only for what you use. And so you don't have the concern about what am I going to do when I'm not there. And because you're doing that, it's also much more flexible. Because you're paying only for what you use, you reserve or preserve resources to do other things. The complications or the complexity, I think, are in the ownership arrangements and the structure of the ownership, and how decision making occurs, who decides which people get which weeks or weekends, who decides how to maintain the property, how easy it is to get out if you want to get out. Those are all considerations that I would be interested in knowing about before making a decision like that.
Right. This is a question from Phil. He asks, what about capital gains if you sell the home to rent? What about step up in value if your partner dies?
Well, there's a lot, there are several things going on in that question. So if your partner has died before you sell, then you're going to get only half of the allowance. You'll get the step up on the partner's half, and you'll get the tax exclusion on your half, or you'll get half of the couple's tax exclusion, right? You'll get 250,000 instead of 500,000. But I'm not sure beyond that what the question is. So if the partner dies, then suppose the house is worth $1 million, and you paid 400,000 for it, then and the partner dies, you get a step up in basis on half. So that's going to take the basis from 400,000 to 700,000, and then if you sell it, then you'll have a $250,000 exclusion, and you'll owe tax on the 50,000 difference. So you're selling it for, you'll get $250,000 of exclusion, and that will leave you with 50,000 on which you owe capital gains tax.
Right.
Should I say that again, Alex?
I think that makes sense. We might have a question that references that again. So
okay.
Just in the spirit of time, we'll keep moving here. This is a question from WJ. He says, you mentioned HECM as a means to provide liquidity in your home, but a HECM LOC also protects against loss in home value if taken early enough because of growth in principal. Is that true?
HECMs are a complex subject. There is the advantage that was mentioned about the line of credit and how the line of credit grows over time. It's not related, however, as I understand it, to the change in value of the property. It's simply a growth that's based on the interest rate, the prevailing interest rate on the loan. So there are advantages to the HECM. I would say that I would refer to, I think Larry has done a webinar on this in this series on HECMs. Is that right, Alex?
That's correct. Yeah, he mentioned that along in a webinar with Tom Dixon. So I would maybe refer to that. And of course, our webinars are posted on the website.
Okay, so I would encourage you to go there, because as I say, HECMs are a complex subject, and I'd like to I'd like to avoid trying to create an example on the fly here.
Right. Maybe you could just answer quickly though from Jeffrey. He just asked, what is a HECM?
A HECM is the legal name or the legal acronym for a reverse mortgage. And a reverse mortgage is a loan that people older than 62 can take on their homes. The proceeds of the loan can be taken in several different ways, either as a lump sum or as an annual draw or a monthly draw. But no interest accrues and accumulates, but does not need to be paid. So the size of the loan, if one takes money out against the HECM, then interest starts to accrue. The size of the debt will grow, and the loan is what is called a non-recourse loan. So first of all, the payment is not due on the loan until, if it's a couple that took out the HECM, until the second one moves out of the house or dies. And then the lending institution is limited in the amount that it can recover to the value of the house. So if the house is worth, let's say, $600,000 and the loan has accumulated to $800,000, the lending institution can sell the house for $600,000, and then that satisfies the obligation of the homeowner. So even if, let's say, the homeowner had other assets, the lending institution cannot attach those assets. And that difference, let's say in the case I just illustrated, between the $800,000 loan balance and the $600,000 value of the house, that difference is made up for the lending institution by insurance that's provided by the federal government, and that is paid for by an insurance premium that's paid by the borrower at the inception of the loan.
Right. Apologies if you hear Larry's cat in the background. He's agitated about something. Here is a question from Bill. He says, in the slide presenting costs of vacation home ownership, does it include one-time costs usually for furnishing the vacation home? For example, beds, tables, lamps, chairs, kitchen equipment, utensils, etc.?
No, it did not. And I guess I would say that since the Robinsons have $1 million house and they're downsizing to buy a $750,000 house, that $750,000 house is smaller, and they've got extra furniture that they're going to use to furnish the vacation home. But of course, if you were thinking about buying a vacation home, and you were going to furnish it, you would have to include the cost of furnishings in your analysis.
Right. Right.
And I will say that um, I chose the examples to highlight what I think the main issues are, and so there's a, a certain lack of realism in some cases, such as that one.
Right. Right. Okay, let's go to Richard's question here. It says, at the beginning of today's seminar, you mentioned the CCRC model. Will you do a discussion of CCRC/life contract decision making sometime in the future?
I will. Let's Alex, let's list that as something that we might want to consider in
Okay.
a future webinar. That's a really good idea.
Yeah, I'll make a note of that. That would be a good idea. Okay. Here's a good question, and it's a pity Larry isn't here for this, but I think you can answer just as well. This is from a different Richard. He says, with current changes in inflation and the pandemic economy, what is the effect on housing if we have an inflationary depression?
An inflationary depression. So I guess that means, what is the impact on housing if inflation accelerates and we have a contraction in the economy?
I guess that's what that means when
Okay.
inflation becomes a problem.
So so there are um, maybe the easiest way to deal with this is in two parts. So if there is inflation, then home ownership is advantaged because a home is a real asset, and it's likely that its value will keep up with inflation. If there is a depression, it's likely that real values of houses would decline because real incomes will decline, and that would mean that overall in the economy there would be less demand for housing. People would be able to afford only smaller houses and less housing in general, and we'd expect housing prices to fall, real housing prices to fall.
Right. Let's see. I'm just going to try and find here's a question from John. It says, you don't address taxes much. In effect, retirement income, property, Social Security, sales, and inheritance death taxes, and how different states may be more retiree friendly. Maxify looks at this and can help you determine if you can now afford the home lifestyle if you move to, for example, Nevada, which is very tax friendly, from New York, which is not at all tax friendly.
Mm-hmm.
And he goes on to say, we found the tax savings alone can pay for a pretty decent, $8,000 more in annual vacation.
Mm-hmm.
This is a question actually many people have been asking here, so I think this is a good one.
So I think that the question is, can taxes matter, or can costs in different parts of the country matter? And the answer is yes.
Right.
I didn't focus on those because I was trying to focus on the economics of buy versus rent, or how much house you can afford, or whatever the question is, whichever of the four questions that we looked at. But in making the decision, you have to think about all of the factors, all of the economic factors that enter in, and taxes would certainly be one of them. I think that the tax consideration that people are least likely to think about is the fact that imputed rent is not taxed, and that's an advantage for home ownership. But the differences in state taxes are clearly a factor in one's total cost of living.
Right. This is a question and a comment from Steven, and you might as well respond to the comment part as well. He says, in the rent versus own scenario, it does seem that you have accounted for increasing rents over time versus stable monthly payments in fixed nominal dollars for owning. Can you speak to that? And then as a comment, he says, also, I know you are presenting objective information, but it does seem you may also have a subjective bias towards renting versus owning. Is that true?
No. So first of all, no, I do not have a subjective preference for renting versus owning. I think it depends on the circumstances. If especially if one is thinking about being in a place or in a residence for a relatively short time, then renting is advantaged because the transaction costs are smaller. If one is thinking about being in a place for a longer period of time, then on the just on the transaction from the perspective of transaction costs, the owning is going to be better. I think that one point that I've emphasized here that I think tends not to be emphasized when thinking about renting versus owning is the risk of owning a house and the fact that it is a concentrated asset and that prices are variable, and that especially if one's plan depends upon being able to sell a property for a specific price. In general, financial planners, and I'll plead guilty, financial planners tend to assume that that price is going to be realized, but that may not be the case. And if you were trying to sell your house at the bottom of the house price decline in the great financial crisis, you would have been very disappointed in the price that you might receive. So I responded to the comment first. Can you go back and now read the question again so that I can be sure that I respond correctly?
Let me see if I can find it, because that might be a problem for me, given that I'm sort of 2 steps ahead trying to find the next question.
I see.
Yeah. Yeah. I'm not sure if I'm able to find that. Apologies, Rick. But
Okay.
I do think that I do think it was good for you to say that you don't have a bias here towards renting.
No, I don't. I think that renting and buying each has its place.
Right.
And I think especially if you're experimenting, it's great to have the option to rent before you buy. Let's leave it there.
Right. Okay, let me just try to find another question here that's good for us. Well, this is sort of something that other people have asked, and apologies if this is redundant, but this is from Dan. He says, assuming you have the assets to pay full purchase price, is there a tax efficient way or approach to buy a retirement second home, like selling investments and buying outright, or getting a mortgage and redeeming investments and pay down some every year to stay within a tax bracket, et cetera? So there's been a couple of questions about the value of buying outright versus acquiring a mortgage. Maybe you could speak to that.
Well, first let me say that I know that Larry is not a fan of mortgages, and his argument is that it's tax inefficient, first of all, and secondly, that you're paying the lender's margin, which is an expense that you don't have to pay if you don't take a mortgage. Um, I would, in general, to take a mortgage or not has very small impact on living standard. If you run it in Maxify with a mortgage or without a mortgage, you find very little difference, and there may be some advantage to um, paying cash, but it's likely to be small. The um, the question about uh, tax brackets and equalizing tax brackets over time, um, that's definitely relevant. And if you have a lot of your financial assets in retirement accounts, and you're in a relatively or taking money out to um, let's say to make a capital purchase. So suppose that you're 65 and you're thinking about buying a vacation home. You don't have the cash to buy the vacation home except in your retirement accounts. And uh, suppose it's a $400,000 vacation home. You have $400,000 in retirement accounts that you could liquidate, but they're all in pre-tax retirement accounts. So you're taking the $400,000 out is going to be $400,000 of income, and that's going to push you into the top tax bracket. Then there's and ordinarily you're just to make it dramatic. Ordinarily you're in the 12% bracket. Then it's going to be very expensive to take the distribution to buy the house, and it's going to be much more tax efficient and much more financially efficient to take the mortgage and use the mortgage as a mechanism for smoothing your IRA distributions for the purchase of the house.
Right. Right. A couple of questions about proposed tax legislation coming from Washington, and a particular question here from Doug. It says, with the latest tax law putting a cap on salt, has that removed some of the benefit of owning? And as far as I know, that has not actually gone into effect.
But that should have limited impact on the benefits of owning. That the um, uh, the impact on um, state income taxes um, and state property taxes, I would expect that to sort of wash through both the ownership and rental markets. And so I would not see that as having much impact on the benefits of owning, the relative
Okay.
benefits of owning.
Here's a good question. This is from June. She says, I liked your remark that in retirement and older years, one wants a situation that allows, quote, flexibility without nimbleness. Could you give examples of situations that achieve this?
Sure. If you buy a house, a retirement home, that's all on one level. One of the big reasons that people later in life have to move is that their homes have stairs, and stairs become more difficult, or perhaps in some cases more dangerous as
Right.
people get older. So having a house that's all on one level gives you flexibility without requiring nimbleness. If you have a home that has, let's say, an in-law suite, then that allows you to have live-in help if you need it without um, changing where you live. So those are two examples that I can think of, just sort of quickly. But I think that's the that they both are variations on that theme.
Yeah, I wonder if we can maybe for a future webinar get a guest to sort of has some expertise in thinking of things like just like what you were talking about there for people to think about in the future. Let's see. This is from Jim, and you know, you don't have to give any direct advice here, but he says, we are retired and would like to move overseas to Portugal and rent to see if we like it as much to live as we do to vacation there. Our home is not paid for, so we were considering renting it versus selling. Any thoughts?
Boy, there's a lot going on there. And yes, first of all, I can't give personal advice, but
That's right.
I would say that first of all, when one is thinking about living overseas in retirement, the managing what we call social insurance, and in particular medical insurance, is a very important consideration. And understanding how one is going to fund medical care, what insurance one is going to have to fund medical care, is very important. As far as whether one who's thinking of moving, let's say, suppose that one was thinking of moving from one's family home to another home and far away. Suppose not as far as Portugal, but suppose they were thinking of moving to Salt Lake City, and they had a house in Boston, and they weren't sure whether they would really like Salt Lake City or not. So they plan to spend a year, they rent a place, and the question is, should they sell their home in Boston? And my answer would be, well, if you can get a renter, then keeping your home gives you the option of returning to your home without incurring the transaction cost of selling and then buying another house. Suppose you go to Salt Lake City and you don't like it and you decide you're going to live in Boston for the rest of your life. If you've sold your house, you've incurred that transaction cost, and now you're going to have to incur another transaction cost to buy another one. So if you have a house you like and you're trying something else, keeping it is, I would think, advantageous.
Right. I want to repeat something that Rob here mentioned about the previous question. He said, another example of flexibility is the availability of in-home care services. I encounter people who retired to rural areas where in-home care services do not exist. And I've also encountered that. I've known people who have had problems finding hospice care, for example, in rural areas. So that's another thing to think about.
Both good examples.
Yes, both good examples. Let's see here. Oh, yes, and this is maybe somewhat related. There's a question from Patty. I am wondering about the ownership versus rental comparison in terms of a Medicaid spend down, or do you assume long-term care insurance?
That is another that can be a complex question. I'd rather I think not try to address that here.
Okay. Maybe Patty can email.
Maybe Patty could send you email you the question.
That's right. And there's a lot of, yeah, I was going to say that, and there are some questions that are either a little esoteric or maybe too particular for today. Just feel free to email me at alex@economicsecurityplanning.com, and we can see how we can help you. Let's see. This is a question from Daniel. He said, at the start of the lecture, you cited the appreciation in housing prices, the long term being 0.5%. Was that inflation adjusted? in
Yes.
effect, is the number a negative 2.5% loss
No.
after inflation?
No.
No.
It is 0.5% after inflation. It's a real appreciation.
Okay. Let's see. This is from Charles. It's just a quick question. Could you elaborate further on the opportunity cost of investment in a house?
The opportunity cost of investment is simply the return that one could receive on that asset. And in general, I'm using the risk-free rate of return that one could achieve. So I'm using 0.5% real, which is the risk-free rate right now. So if in the case of the $750,000 house, one takes $750,000 out of treasuries or out of, and treasuries is probably the best example of a risk-free investment, right? Then you're giving up maybe 0.5% real right now. And that's the opportunity cost. That's the return that you could have earned on that money if you didn't put it in the house.
Right. Okay, so new questions are sort of slowing down. We still have a lot of questions, obviously. Let's see. Here's a question from, and we are going to end at the end of the hour here, but this is a question from Michael. See if you can understand this, Rick. It says, if the reserve fund is invested, how would a significant market decline, say 40%, reflect the buy versus rent comparison?
Okay, so if we're looking at a reserve fund, in the example that I was using, I had the reserve fund invested in a risk-free asset, so the market decline would not have affected that. If you're thinking about a large decline in the value of the house, then the reserve fund is clearly advantaged, and the rent and reserve fund approach is clearly advantaged. If you're thinking about a 40% stock market decline, and you had invested the $750,000 all in stocks, then clearly that would not be a good outcome. What I was trying to do was to encourage people to think about the potential benefits of diversification and diversified investment that one can make in a reserve fund, let's say, as opposed to having the money invested in a house, which is illiquid, and where price declines are very hard to avoid, right? Unavoidable and not diversifiable, unfortunately. And that's the point I was going to make. We can construct all kinds of scenarios for changes in prices of housing and changes in the way the reserve fund is invested and how those investments turn out. And each of those scenarios is going to have a different result, and it's going to make the decision after the fact appear to have been right or wrong, right? So, but what I'm trying to do is with the reserve fund example is to encourage people to think about the home as an investment, and as an investment which is illiquid and which is not diversified. So if house prices start to drop, it's very difficult to exit. If you said, boy, I've taken a 10% drop in my house, I don't want to take any more, I'm going to sell. If the market's declining, there may not be buyers. You may be stuck watching the price continue to decline. If you have financial assets, they're much more liquid. So I think that's the point I was trying to make, rather than to say I was assuming that stocks would return a certain amount, or bonds would return a certain amount, or houses would return a certain amount. So it's a difference in portfolio composition rather than I'm suggesting that there's a difference in portfolio composition. I'm not saying that there's a predictable difference in outcomes.
Right. Okay, I'm going to go back a little bit and ask a question from Nancy. She says, with renting, one is at the mercy of the landlord extending the lease. It can be very disruptive when the landlord decides to sell the rental property, forcing you to move. Also, landlords also aren't necessarily responsive to tenant requests for repairs. Toilets and water heaters may go unrepaired for weeks to months with unresponsive landlords. And Nancy, I should add that right now, currently, my landlord would like to kick me out of my house for 8 months to redo our foundation, which seems pretty ridiculous. Anyways, how does that factor into this consideration of buying versus renting?
I am sorry that Nancy is having such a difficult time with her landlord. First of all, landlords vary in their responsibility, just as towns vary in how well they keep up the streets, the quality of the schools, etc. So there are difficulties that are associated with either buying or renting that I abstracted from, and clearly
Right.
having a difficult landlord to deal with is not something that one likes, and would be a reason, to the extent that one can find out about the quality of the landlord before renting, that would be something that would be good to do.
Yes, and I want to say, Nancy, I commiserate with your situation. Carol asked for my email address again, so I'm just going to give that one more time. It's alex@economicsecurityplanning.com. And a couple people, I think on your last slide, Rick, you mentioned your telephone number. I think people were maybe a little confused about the.
I see that. Just a minute and see if I can make that better. Hold on just one moment. Here we go. Oh, I'm having a little trouble with, I would like to be able to edit it.
Well, maybe we could just say it out
Here we
loud.
are. No, here we are.
Oh.
I can do that. We are in good shape.
Oh.
There.
That's right.
Okay.
And do you have an extension on that, or
I have an extension. I have an extension. It's 114.
It's 114. Okay. Okay. Let's proceed here. Tricia says that she would like to see a webinar on long-term care or how to fund long-term care needs. I agree with that, Tricia. Hopefully we can do that in the future. Here's another question from David regarding inflation. He says, if inflation is correlated with higher mortgage rates, does this reduce the extent to which housing prices will keep up with inflation? Could inflation even result in a reduction in housing prices under certain circumstances?
Housing prices should be related to real interest rates, because the price of the house is the present discounted value of the series of rental flows that I talked about. Mortgage rates per se, in other words, mortgage rates as distinct from interest rates more broadly, will have a less direct effect on housing prices. I know that the popular press talks about the impact of mortgage rates on house prices, but my suspicion is, and I'm not familiar with the research, but my suspicion is that it's interest rates more broadly that have that impact.
Right. That's my suspicion too. Here's a question from Harvey from a little while back. He says, "Isn't longevity risk, which is the unpredictable survival length of one's life, better served by owning than renting?"
It is. Yes. I thought that I said that.
Okay. Sorry.
But
Yeah.
It is the because you've purchased a stream of return or a stream of housing that lasts indefinitely. It should last throughout your life. So here, let's see if I can find it. Yes, here on here. When you buy one of the financial advantages is that you've bought longevity insurance. You've prepaid rent.
Right. Right.
Right. So if we go forward here, so when you buy, you've bought an indefinite stream of housing services, and therefore you've paid for a place to live effectively for the rest of your life. Now, you haven't fully paid for it because there are costs that are not included in the purchase price. There's the real estate taxes, and there's the insurance, and there's also maintenance. But you could decide that you were going to let the house depreciate and not keep it up. So you could live and many people in practice do that. But yes, there is a longevity insurance like benefit of ownership.
Right. This is an interesting question. I don't know if you've already answered it. This is from Jim. He says, "How well does land value appreciation offset depreciating house value?" And maybe we talk about that.
We don't have the data on that.
Okay.
Schiller's data is only on the two of them together, and we could speculate on this. It would be fun to speculate, but I don't think that I have any data or any real knowledge about that.
Yeah, and I know that some people have asked about purchasing a house with regards to climate change. I think that's sort of relevant to that question as well.
I can say that one would be I'd say it differently. My sense is that a lot of people who have homes right on the water are facing rising insurance prices because of concern about climate change and because of increased losses due to hurricanes.
Right.
And so that would be a source of or a cause for some caution, I guess. So that's something that one would think about in projecting, let's say, the investment risk or in consider or in trying to assess the investment risk associated with houses in different markets?
Yes, yeah. Um, Here's a question from Dave, and let me see if we can figure out exactly what he's asking here. He says missing from the buy versus rent analysis was renting the present house and either purchasing or renting a downsized or dream size house. In general, how would that impact the analyses?
So say that again, please.
Missing from the buy versus rent analysis was renting the present house and either purchasing or renting a downsized or dream size house. In general, how would that impact the analysis?
I see. So I'm understanding that to be a question about keeping the current house
Right.
and
I think
and
that's right.
buying or renting a new place, right? And
Correct.
in general, um, that is something that I would be less likely to advise, fundamentally because of um, the people, whoever does that. If you keep a house and buy another house, then added you've added to your concentrated investment risk. And even though it may be diversified, you may have diversified because you bought a house someplace else, so you're in two different geographic markets, you still have two concentrated assets, undiversified assets. And that's, unless you are in the business of uh, owning residential real estate and renting it out, and you have multiple properties, and that's uh, that's something that you do as a let's say it's a business that you've decided that you're going to operate while you're retired. Unless it's that, I would tend not to be supportive just because of the investment risk. It's a risk you don't need to take. Now, you could say, well, I'm planning to move back, and if you know you're going to move back, or there's a high likelihood you could move back, then and we're thinking about a relatively short period of time, then yeah, okay, because we're avoiding that transaction cost, and that could make sense. But if we're thinking about it as a long-term investment, in general, because it's not diversified, that's not something that I would advocate.
Let's see here. I'm just trying to find a good question here about. There's lots of questions. Lots of questions about inflation, and I know that we've talked about that, but I have another one for you. This is from Robert. He says, assuming you're a 70-year-old couple are about to uh, sell their primary residence, invest the equity cash to be used towards living expenses and rent, are they better or worse off if we head into an inflationary trend in the economy that lasts 7 to 10 years?
So that I think that the question is, in a sense, about investments and how to invest in an inflationary environment. And the um, the short answer is that I think.
Well, I
Go ahead.
think that's right, but based on selling their primary residence and investing the equity cash that they receive from that,
Right.
right,
So, but I think the question is, if they're investing that equity cash in an environment with inflation,
right,
right? In fact, in an investment environment with inflation,
right, but they rent too.
but they rent too, right? Well, you want if you think about now, we should be thinking about the sort of the total balance sheet. So some of the income is Social Security income. That's inflation protected. If there is pension income, that may not be inflation protected. So, but that's independent of housing, right? That the real income will decline independent of the housing decision that you make. You could say, well, if I own, yeah. So if I'm in a situation where I've got a lot of income that's not inflation protected, then you might not want to sell the house that you have, because the house is a real asset, and the um, the housing services that it generates will be the same in real terms, regardless of what happens to inflation. Whereas if you're sort of worst case scenario, you sell the house that's delivering real housing services, and you take the proceeds and you hold them in cash. Cash is not going to keep up with inflation, and so that's kind of the worst possible thing to do. So you want investments that will keep up with inflation, or are more likely to keep up with inflation. And depending upon whether inflation is predictable or not, if inflation is unpredictable, then TIPS are going to be your best fixed income option, and I bonds. And as far as stocks are concerned, they are an imperfect inflation hedge, because the research that I've seen suggests that they are not, stock returns are not correlated, or not well correlated with inflation. So you may lose ground relative to inflation, or you may not, but it's just not known.
Right. So we have 4 more minutes here. I want to repeat a comment that Rob just made, which I think is an interesting one. He says, don't forget that the complexity of being a property manager becomes overwhelming late in life, whether you're a property manager for rental property from which you derive income, or you're the property manager for the house you live in. And I think that's really true. I mean, my old landlord passed away last year, and he had several properties, and his estate was a complete mess, because towards the end of his life, he just didn't have the capacity to manage all of these things. So that's something to keep in mind. But let's see if we can find maybe a final question for you, Rick.
No, I like the comment. I like the comment, and I think
yeah.
But I think that it's broader than just property management. I think that as people get older, it becomes more and more difficult to manage one's financial affairs in just broadly, and so making arrangements to help with that is very important. And those financial affairs can include ownership. They can include, property ownership, home ownership. They can include investments, and just paying bills. So having arrangements that provide trustworthy support is very valuable as one gets older.
So maybe let's do one final question. How does that sound, Rick?
That's fine.
Okay. And if it's not a good one, we can do a second one. A lot of questions are about basically, how much costs vary from state to state, from location to location, even housing insurance. But Here's a personal question from Ted, and again, I preface this that Rick is not here to give personal advice, but he can give a kind of an analysis. He says, I will inherit some Midwestern farmland and face whether to retain or sell. Do you have intuition about retaining farmland and renting personal residence, or selling farmland and purchasing personal residence outright?
Leaving aside the question of buying or renting, farmland or any real property of that sort is a complex investment. It's illiquid, it's concentrated. Unless one is in the business of owning or managing farmland or any other real investment, such as, we could pick, for me, I would say, condos in San Francisco. I know nothing about condos in San Francisco. And if I inherited one, my inclination would be to, I suppose I could go look at it and see if I wanted to live there instead of where I live now. But otherwise, my inclination would be to sell it because it's not a market that I know much about. The investment is illiquid, it's concentrated, and therefore there's a lot of investment risk associated with it. And that's risk that I would prefer not to bear because I have no special knowledge about condos in San Francisco.
So what do you think? I think that maybe this is a good place to wrap up. I think this was a fantastic webinar. I'm so thankful to have you on, Rick, as always, and I'm looking forward to having you back on when we can do this again.
Well, thank you very much. It was a pleasure to be here and to be with everyone.
And once again, if anyone has any more questions, please just email me at alex@economicsecurityplanning.com. And until next time, thank you, everyone.